Hey everyone, welcome back to Corporate Decoder. Today, LRHC just filed an 8K detailing a restatement of previously issued financial results, and there is one critical accounting mess that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is admitting they messed up revenue recognition and will need to fix past financial reports, and this is a big deal for how we see their true performance. We are looking at a Form 8K, which is basically a report for big, important events that happen between the usual quarterly earnings reports. In this case, the big event is that Rosa Holdings Corp is telling the world they got their accounting wrong for revenue and costs reported in the past. Rosa Holdings Corp is a real estate services company, and it looks like they had some issues with how they reported revenue, especially when it comes to property management fees. This section here, item 4.02, is the heart of the filing. It announces that the company is no longer confident in some of its past financial statements. Think of it like admitting they made a mistake and need to go back and correct the record. So, the company's audit committee, which is the group responsible for overseeing the financial reporting, found problems. They need to fix the way they recorded revenue and the costs related to that revenue. This affects their annual report from 2024 and several quarterly reports up until September of 2020. 5. These periods are now considered affected periods, meaning they need correction. Here is where the accounting gets tricky, but let's break it down. Rosa Holdings acts as a property manager. They were recording the total rent collected from tenants as their own revenue, but after looking closely at their contracts and following accounting rules, specifically ASSE 606, they realized they were just acting as an agent, like a middleman. For these rental agreements, they weren't the principal owner of the property or the actual service provider in those transactions. This means they should have only recorded the fee they earned for managing the property, not the entire rent amount, so they have to go back and fix their reported revenue to only include the fees they actually received. This is the revenues adjustment. Because they were incorrectly including tenant revenues in their own revenue, they were also incorrectly including payments related to those tenant revenues as their costs. So when they reduce the revenue, they also need to reduce the associated costs to match. It is like if you sell a product and report the full price as your income, but then you also report the full cost of the customer's raw materials as your expense. It just does not add up. Now for the numbers for the fiscal year ending December 31st, 2024, they are reducing their reported gross property management fee revenue by a significant $10.8 million. And just like we talked about, they are also reducing the cost of revenue by the same amount. This means the actual cash flow and profitability metrics reported previously were inflated. This is an interesting consequence. While the total revenue and costs are going down, the gross margin percentage is actually going up. This sounds counterintuitive, but because they are removing both the top line revenue and the direct costs associated with it proportionally, the gap between the remaining revenue and remaining costs represents a higher percentage of the adjusted revenue. For the fiscal year 2024, their gross margin percentage is moving from 8.57% to 10.14%. This means that after this correction, the remaining revenue that they get to keep is a slightly larger slice of the pie. It is crucial to note that the company has discussed these issues with their independent auditors, CBCPA's PC. This shows they are not doing this in a vacuum and are working with their accountants to make these corrections. This report is signed by Joseph LaRosa, the Chief Executive Officer. This indicates that the leadership is aware of and responsible for the information being disclosed, including the need to restate past financial reports. This filing is with the Securities and Exchange Commission, or SEC, the US government agency that oversees the stock market and protects investors. Companies have to file reports like this to keep the public informed about important company events. This is a current report filed on Form 8K, which is used to announce major corporate events that shareholders should know about. Now, let's put this into perspective. Rosa Holdings Corp is a real estate services company with a market cap of around $2 million and about 39 employees. They have recently been in the news for other reasons too, like getting a NASDAQ warning about delayed filings, and their stock has seen some downward pressure. This revenue restatement adds another layer of concern. The core issue here is accounting for revenue. When a company acts as an agent versus a principal, it significantly impacts how revenue is reported. As an agent, you are essentially a pass-through entity earning a commission or fee. As a principal, you are taking on more risk and ownership and therefore report the full transaction value by incorrectly reporting gross revenue instead of net fees. Rosa Holdings was overstating its size and activity. The fact that they are restating financial statements for periods going back to early 2024 and even the entire year of 2024 suggests the accounting errors were not minor oversights, but systemic issues impacting multiple reports. A $10.8 million reduction in gross revenue for the year 2024 is substantial for a company of this size. While the gross margin percentage improves slightly after the adjustment, it is important to remember that the absolute dollar amount of gross profit is likely decreasing or remaining the same, as the revenue decrease is matched by a cost decrease. The goal of accounting rules like ASCE 606 is to provide a true and fair view of a company's financial performance. This restatement indicates that previous reports did not meet that standard. For investors, this raises questions about the quality of internal controls and the accuracy of financial reporting. Similar situations in the past have sometimes led to further scrutiny, and in smaller companies can sometimes be a precursor to bigger financial problems. While this filing doesn't explicitly state a going concern issue or bankruptcy, it does highlight a significant accounting misstep. Comparing this to other smaller companies that have faced accounting restatements, the long-term impact can vary widely. Some are able to recover and implement better controls, while others struggle to regain investor confidence. The biggest concern here for investors is trust. When a company has to correct its past financial statements, it shakes confidence in the management and their ability to accurately report performance. The improvement in the gross margin percentage is a small silver lining, but it does not erase the fact that previous financial reports were misleading. What I'm actually looking for next is how the company's management addresses these underlying issues, and whether subsequent financial reports demonstrate a sustained improvement in accounting practices and internal controls. It is also worth watching how the market reacts to this restatement, and if there are any further investigations or challenges from regulators or investors. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord for more.